Markets have been regaining some of their losses over the past few days. We're waffling here today, though. Investors still staying defensive. Critical readings on the economic growth and inflation are trickling out over the next few days, and that could put an end to some of this momentum that we've been tracking. So for more on staying defensive in times of uncertainty, we've got Michael Gayed, who is the Tidal Financial Group portfolio manager and publisher of the Lead Lag Report. Great to have you back in studio.
Yeah, no, I appreciate the invite, sure.
Absolutely. So let's talk about this. I mean, because even today we're seeing some waffling in the markets and a lot of investors out there perhaps wondering what does it mean to be defensive in an environment like this where you've got economic data, and then you've also got earnings, which are going to send things teetering a little bit.
Well, I always say that path matters more than prediction because people respond off of path behavior. And I think there's this idea out there that playing defense means you either sell or you short equities. I have a problem with that. A lot of studies show that that doesn't work. Market timing doesn't work. I think the proper way to think about what defense means is how do you lower exposure to the factor which is likely to be most volatile? So defense is more about lowering your volatility profile as opposed to trying to make a directional bet.
And so with that in mind, what is the best way, especially amid a time where you're going to hear a lot of chatter either from the Fed speak that we heard last week or from CEOs over the course of the earnings season, where you can stay invested and still stay defensive at the same time?
Yeah, so if you go with that framework that it's around volatility, right, then the question is what tends to benefit from volatility in equities? Now, the reality is, look, most things are tied to equities, meaning most things are variations of beta. So if you're going to try to play defense while still being long only, which is really the only way to be defensive in my view, there's really kind of four main options for things that tend to benefit from stock market volatility. Those tend to be the utility sector, that's actually outperformed nicely the last several weeks. Gold itself, which we can maybe touch on. Usually long duration treasuries, not yet, I think that's still coming. And then betting on the dollar from a currency perspective, because usually in a volatile equity market, there's a flight to safety into the greenback. Those four tend to be not only leading signals of volatility to come, but also beneficiaries.
You mentioned gold. Let's talk about that a little bit more. We've seen quite the run up in gold. And a lot of people wondering, all right, is 2,500 the next big marker that we can get to and still see some type of momentum? What are you tracking there?
So it's interesting, I put a piece out on Investor Place yesterday. I'm actually blown away with how quickly people are willing to say that the trend for gold is now broken. You had a pretty sizable down move a couple of days ago.
You don't think it is?
I don't, because I don't think a trend breaks when you have skepticism, right? I think you need to have certainty. When you have too much certainty, that's what creates the turning point. The fact that people are still doubtful around gold still continuing probably tells me that it's going to keep on going. And I've said this before, I think gold is sending a warning. I thought it was sending a warning about war.
Yeah.
It may still be doing so. I think it's also maybe sending a warning about the yen, currency potential crisis that we may be starting to be in. So I don't think it makes sense to necessarily panic out of gold now. Gold has done nothing for a decade plus, right? So it's only just now starting to wake up.
You mentioned geopolitical uncertainty and whether there's a correlation there to gold. Sure, certainly in the past there has been. And so there's largely the question of what that also means for other elements of your portfolio that hinge on geopolitical uncertainty, or what we would typically bucket as maybe an exogenous threat, to the extent that something arises that we did not anticipate at all, even that in that geopolitical realm.
So I go back to path matters more with prediction. So let's say markets were to take a big hit because something happens overseas. If you got a long enough time frame, that's going to get resolved, right? If you're trying to be more active and tactical, all that means is just lower your risk profile. Still be long, because for all the concerns around geopolitical risks, it may not actually plan out, or it may not plan out in the time frame that you're thinking that it will. It goes back to why market timing doesn't work. So I think when you're in these kind of junctures, the best thing to do is just lower your profile, be prepared. If you have long enough time frame, it really doesn't matter.
Michael Gayed, who is the Tidal Financial Group portfolio manager and publisher of the Lead Lag Report. Thanks so much for taking the time.
I appreciate it. Thank you.
Absolutely.